Okay, tax. Let's get this out of the way nice and early. We all hate it. It's a dirty word, but I'd encourage you just to remember one thing. If you're paying it, you're making it. I mean, you know, income tax, capital gains tax. If you're having to pay it, it means that you've made a gain somewhere. So that's not such a bad thing. There's three key areas I'd like to touch on. Just before I do, quickly, housekeeping, I guess. Marginal tax rates are changing from July 2012, mainly in the area of the tax-free amount between zero. It used to be $0 and $6,000. Now it's $0 and $18,000. I hope that doesn't affect too many of you out there, but just something to keep an eye on. Three key areas in terms of tax planning. Salary sacrifice is the first one. Salary sacrifice basically involves sacrificing a portion of your pre-tax salary, directing it to another source. Now, the example I want to touch on tonight is superannuation, and I know the majority of the people in this audience are young, and super is not something you want to think about, but there's a couple of key, we'll touch more on the nuts and bolts of super in a minute, but at the end of the day, super's there for your retirement, and the rules have changed. It's harder to get money into super later in life, so it's something that should be considered earlier in life, and you can get some tax benefits from it as well. Quick example here, we've got John. He earns $150,000 a year. He gets employer contributions of 9%, so that's $13,500 going into super. He pays tax at about $45,500. So if John wanted to get some kind of, I guess, tax minimisation, he could look at a salary sacrifice strategy. Now, he can put up to $25,000 a year into super. So here he chooses to salary sacrifice $11,500. He reduces his gross income and his tax payable down to around about $41,000. So there's a $4,500 gain to be achieved through this this strategy that goes into super. His after-tax benefit, his out-of-pocket expense is not actually $11,500 because he's reducing his taxable income and therefore paying less tax. So it's actually about $7,000 that he has to go without. So just a quick strategy there. Now, negative gearing, it's not something that we recommend or advocate as a tax minimisation strategy, but a lot of you out there are probably thinking about it. I'll give you this simple example. If you borrow money to purchase an asset, and the cost of that borrowing, the interest, is say $20,000. The income that asset produces is like about $10,000 as an example. You've got a cash flow shortfall of 10 grand. That's not to say that your tax benefit or the tax benefit is 10 grand. You need to apply, it's actually a tax deduction, so you need to apply your marginal tax rate to that $10,000. So say you're on the 40 cents in the dollar range, you get a benefit of $4,000. You're making a cash flow loss of 6. So to make this strategy worthwhile long term, the asset needs to appreciate by $6,000 a year for you just to break even. So the message here is, yeah, it can be a powerful strategy if you've got a good asset, but the motivation for such a strategy should be the asset itself, not the tax impact. Does that make sense? So asset first, tax consequence second. Asset ownership, just quickly want to touch on this. If you're a single person out there, it's very difficult to do anything about, you know, asset ownership. But if you are, you know, husband, wife, you've got kids, you might look to perhaps put that asset into joint names, or you might decide to purchase that asset in the lower income earner to access the lower tax bracket. Now, some of you out there are small business owners, or you may be thinking about owning a small business. You may want to consider, in conjunction with your accountant, you may want to consider a trust, perhaps a family trust. And basically, a family trust allows you to own an asset in a separate legal entity, and underneath that you'll have beneficiaries, husband, wife, kids, particularly adult kids. It becomes of great benefit to you, and you can distribute distributions, you know, income or realised capital gains to those people, so you can spread the tax impact out.